Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. You can't keep a good bull down. The S&P 500, NASDAQ, and even the beleaguered Russell 2000 are all trading at or near record highs. And it's not just U.S. exceptionalism. The MSCI All-Country Index is also at a record high. Over in credit, investment-grade spreads are at 27-year tights. Maybe for good reason. The non-financial debt-to-equity ratio is at or near an all-time low, with data going back 75 years. All this in a stagflationary environment. This week, our three things are: 1. Inflation target. It's quietly slipping. 2. Bond scarcity. Demand versus supply. And 3. Capex Supercycle. We'll compare equity versus debt. All right, let's dig a bit deeper. Inflation target. There's always been lots of debate around the inflation target, this rigid 2% number that has its origins out of a one-off deliberation in New Zealand in the 1980s. True story. The rigidity and origin has always struck us as incongruous with rightfully fluid economic developments and monetary policy initiatives, but that's another story. Just how rigid this target is has come up once again in the context of the Fed's most recent summary of economic projections. Now, to be clear, we realize these projections are not the product of one model. They are a roll-up of the views of 19 contributors, so you should not expect the component elements to necessarily fit. But we do find the median outcomes of the individual line items for 2026 to be curious. Starting with growth, or real GDP, the median is back to what could be called potential, or in this case, the longer-run target, 1.8%. The unemployment rate is low by historic standards at 4.4%. That is to be averaged in the fourth quarter of 2026, but not out of alignment with the growth forecast. The policy rate is forecast to drop by another cut over the course of the year. That'll add up to 3 cuts from today, which could be rationalized as simply removing excess restrictiveness. But then there's the inflation forecast, 2.6% core PCE over the course of 2026. Again, acknowledging that these numbers are medians for the group, not one elegantly unified model, it seems as though there is an acceptance among at least a gaggle of FOMC members of inflation running above that arbitrarily chosen target. Core PCE, for what it's worth, has been above target now since March of 2021, and more than 2 years since the last rate hike. One-year inflation expectations in the latest New York Fed survey, that was for August, are running about 3%. Chair Powell and other members of the FOMC have already signaled that the inflationary effects of tariffs are, in effect, transitory, and that the impact on prices is expected to be a one-time price adjustment. That means market participants should look through that bump up in prices rather than get worked up that a rate hike might be warranted. It means that we can expect the economy to run a bit hotter than it otherwise would, fueled by easier money. Over the near term, that's good for credit, but for obvious reasons, bondholders do not like inflation. The same can be said for central bankers, which means we just might not see rates cut as aggressively as the futures market, or Fed forecasters, are anticipating. All right, on to our second thing, bond scarcity. The supply of bonds continues to grow at quite healthy rates. The latest quarterly report out of SIFMA points that fixed income outstandings, excluding ABS, at June 30th was $47.8 trillion, up 5.5% over the prior year level. The stock of U.S. Treasuries was 7.2% higher, corporates 3.8% higher. Over the past 20 years, total fixed income grew at a 5.7% compound annual growth rate, Treasuries at 10.4%, and corporates at 4.6%. So U.S. Treasury issuance is at an all-time high, and corporate issuance is on pace to be the second highest issuance year, trailing only the federal government-backstopped COVID year of 2020. So what has happened to Treasury and corporate bond yields in 2025? Well, they've gone down. The 10-year Treasury threatened to breach 4% last week before bouncing post the FOMC. Investment-grade corporate yields have been through 5% since August 1st. So supply up, yields down? It's not supposed to work that way. Back in April, a commonly held view was expressed by JP Morgan Asset Management, which cited inflationary trade tensions, softening foreign demand, and fiscal concerns as reasons for upward pressure on Treasury yields. If you asked bond investors which yield threshold was more likely to be crossed first, 4% or 5% on the 10-year Treasury, you'd be hard-pressed to find many in the 4% camp. So something's going on. No doubt, some of the usual explanations for low Treasury bond yields apply. Treasuries remain the ultimate haven asset in the face of heightened risk, be it geopolitical or economic. Softer jobs data in the U.S. raised concerns about the degree to which the U.S. economy was slowing, and policy uncertainty in the U.S. remains high. And then there is the financialization of the global economy, which drives greater demand for hedging programs. All have increased demand for treasuries. You can also factor in the Treasury Secretary's stated goal to manage down the 10-year yield by increasing the use of shorter-dated maturities. And over on the corporate side, there is increased demand for mid to high-quality bonds with their income and diversification attributes in an environment where stocks are undeniably frothy. One more thing is probably at work here. There are not enough bonds out there to meet the level of demand. For years after the GFC, fixed income yields were intentionally depressed by central bank quantitative easing programs. With yields now back toward normal and the world unsettled, the appeal of fixed income has grown dramatically. And barring an unforeseen spike in inflation, we don't see that changing anytime soon. One more consideration: the possibility that a significant portion of the administration's tariffs could be deemed illegal by the Supreme Court. While it's tough to handicap that outcome, the market is clearly not all that concerned, believing that the administration would have a variety of alternative paths open to it, effectively dampening the risk of having to ramp up issuance to replace lost tariff revenue. For now, the market is doing what it hoped the Fed would do: lower rates. All right, on to our third thing: Capex Supercycle. Ordinarily, I don't get too animated about talk of supercycles. Needless to say, analyzing all of the puts and takes along the way are far more productive ways, I think, to spend time. But a couple of reports that came out this week got our attention: Bain & Company's annual technology report and a McKinsey report entitled The Infrastructure Moment. Both reports speak to a technological wave that is running and challenging the public and private sectors to keep pace. Bain says AI is the defining disruptor of our time. AI's reach is broader than any recent tech wave, reshaping business strategy, politics, trade, defense, and even social justice. McKinsey, with a broader view of infrastructure, points to a confluence of global forces driving the need for investment, including outdated assets, rapid urbanization, geopolitical shifts, and technological advancements. It calls for a shift in mindset for the good of the world. Okay then. Both reports serve as a call to action. Bain says the economics of meeting the power needs of AI by 2030, in their estimation $500 billion a year in data center capex, are, at the moment, unaffordable. McKinsey, which opts not to pass judgment on feasibility, pegs the broader infrastructure need at $106 trillion, that's with a T, by 2040. By sector, McKinsey breaks down that $106 trillion the following way: 34% earmarked for transportation, 21% energy, 18% digital, that's data centers, towers, etc., 15% social, that's healthcare, education, 5% waste and water, 5% agriculture, and 2% defense. And we'd make the following observations. 1, it represents a new global arms race, especially as it relates to technology. 2, the size of these numbers will require public and private sector commitment on a global basis. 3, fiscal constraints are not helpful here. Advanced economies are debt-laden, which will limit the level of participation on the part of governments. 4, demographic trends will not be helpful here. Aging population increases the social burden, which threatens to crowd out investment when we need to crowd in. Now, leaving aside the magnitude of what McKinsey implies here, the firm does remind that infrastructure is a critical enabler of long-term economic growth. Historically, capex booms have benefited consumers of a new technology rather than the producers. Think railroads, airlines, or the internet as notable examples. So the long-term play here just might favor fixed income rather than equities. So there you have it. 3 things in credit. 1. Inflation target. 3% doesn't seem so bad. 2. Bond scarcity. There's not enough bonds to meet demand. And 3. Capex Supercycle. There is a time when you will want to play it from the bondholder's side. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.